Lululemon has provided great returns for shareholders since its IPO back in 2007. Its share price is up more than 2,500%, and the stock jumped 20% last month after reporting another strong earnings report. That takes the company up to a valuation of $48 billion. With $1.2 billion of cash and little debt, the enterprise value is $47 billion. Revenue over the last 12 months is $8.1 billion, with $855 million of net income and $328 million of free cash flow. So the business is valued at almost 6 times revenue and 57 times earnings. That's expensive, but Lululemon has grown its top line revenue every year in the last decade, and it's maintained strong gross margins of around 55%, with net income margins around 11%. It's also useful to see how the company has grown its retail footprint. Over the last fiscal year, the company has opened another 81 stores, with the majority across the US and China. And it's had to close only 6 stores, which statistically isn't bad. In fact, revenue increased by almost 30% in the last year, from $6.3 billion to $8.1 billion, which is even higher than the increase in stores. The company also compares favourably against its peers. Its operating margin at 16.4% is more than Adidas, which plunged to 3% last year, and Nike, which sits at 14.3%. This shows the brand strength of the company, and at the Investor Day, management said it wanted to double revenue in 5 years' time and quadruple international growth. Despite all these positives, the price of Lululemon stock does provide some risk to investors. The company's e-commerce segment benefited greatly from the pandemic, and it wouldn't be a surprise to see some slowdown in top-line revenue. If you assume Lululemon can compound revenue at 15% for the next 10 years, then operate with a 12% net margin, earnings would be roughly $4.6 billion in 10 years' time. A 25 times multiple on that figure gets us to an enterprise value of $115 billion, so that works out to an investment return of around 9.4% a year. Overall, retail is a fickle industry, and a 57 times earnings multiple leaves very little margin of safety, which is why I'm going to give the stock a neutral rating, but these are my personal opinions, not financial advice, and I hold no position in this stock. For more detailed investing ideas, make sure to visit our website, overlookedalpha.com.